Welcome to This Explainer. Today, we're diving straight into the story of a company that essentially dictates how money flows around the entire world. For nearly 8 decades, this massive entity has dominated the market, practically unchallenged. Now, the top dogs in finance used to be these big traditional banks with massive balance sheets. But recently, Visa, a humble payments processor, became the world's most valuable financial services company. We're going to unpack the incredible, chaotic, and honestly, almost unbelievable story of how they pulled this off. To really understand the scale we're talking about here, just consider this staggering figure. In 2023 alone, Visa processed a mind-blowing $14.8 trillion in total transaction volume. That is literally more than the GDP of most countries. They have ruthlessly outmaneuvered the competition to become the absolute undisputed king of credit cards. But as you'll see, it definitely didn't start out that way. Okay, let's dive into this, because to understand Visa's massive scale today, we actually have to rewind all the way back to 1904. The whole thing starts with a man named Amedeo Giannini, who was the son of Italian immigrants. He noticed that his community was being completely shut out and discriminated against by traditional banks. So he founded the Bank of Italy in San Francisco, specifically to lend to the working class. Thanks to his sheer generosity and a real vision for everyday people, his bank grew wildly alongside California's booming economy. By the late 1920s, it boasted over $1 billion in assets, and it took on a brand new name, Bank of America. Which brings us to Section 1, the Fresno Drop Disaster. So let's fast forward a bit to the 1950s. The U.S. is right in the middle of a massive post-war economic boom. The middle class is flourishing, consumerism is through the roof, and people are just starting to buy things like cars and appliances on credit. Bank of America's tech-savvy new president, S. Clark Bees, wanted to capitalize on this in a huge way. Enter a middle manager named Joseph Williams. Williams had this bold, totally unprecedented idea. You see, before this, you had to actually sit down with a loan officer to get personal credit, or maybe you had a specific charge card for just one local store. But Williams envisioned a single general-purpose credit card for everywhere. It would have a $300 initial credit limit, a 1-month grace period before you had to pay it off, and an 18% annual interest rate. Now, if you've ever wondered why modern credit card interest rates always seem to hover right around 18%, this is exactly where it started. And amazingly, that figure remained set in stone for 30 whole years. But here is the craziest part of his whole plan. He wanted to issue these cards without any prior applications. None. Let's walk through this timeline, because this turned into one of the wildest events in banking history. In September of 1958, Bank of America initiated what became known as the Fresno Drop. They essentially mailed 60,000 unsolicited, fully active credit cards to almost every single household in Fresno, California. Just imagine that, literal free money arriving in the mail. At first, it seemed like a total triumph, so they immediately started dropping more cards in other cities across California. But a few weeks later, the grim reality set in. Williams had modeled this whole thing assuming a 4% delinquency rate, but it skyrocketed to a shocking 20%. Customers and merchants alike were forging signatures and reporting fake transactions left and right. The ultimate result was a catastrophic $8.8 million loss that cost Williams his job. Moving right along to Section 2, licensing and rampant fraud. So despite the absolute marketing fiasco of the Fresno Drop, it proved one absolutely crucial thing. Everyday people desperately wanted access to credit. By pulling back cards from those delinquent users and deploying aggressive collection agencies, the BankAmericard actually became wildly profitable just a year later. It was so successful, in fact, that by the 1960s, other banks were knocking on the door wanting in. So Bank of America began licensing its well-built infrastructure to other banks for a fee. And this brilliantly illustrates the hidden genius of the entire credit card business. Let's break down how this actually works, because every single time you swipe your card at a store, you're triggering this exact sequence. First, the merchant's bank reimburses the store. Then, the sales draft is sent over to your bank. Your bank then reimburses the merchant bank. But crucially, they take a small fractional cut for themselves. That is the interchange fee. Finally, your bank bills you directly. And that tiny fractional fee, that is the secret engine that prints money with every single swipe. But as this licensing program exploded, a massive flaw in their decentralized system reared its ugly head. Criminals quickly figured out that they didn't even need to rob bank vaults anymore. They could just break into warehouses and steal boxes of unembossed credit cards before they were ever even assigned to a customer. And trying to track this fraud manually back then was virtually impossible. It got so incredibly bad that banks were actually paying ransoms to these criminals just to buy their own cards back. It's wild. With transaction volume absolutely exploding, the entire network was nearing total system failure. This brings us to Section 3, D. Hawk's decentralized vision. Right as the system is collapsing, enter a highly unlikely savior, a man named D. Hawk. He was a frugal, nature-loving Mormon from Utah who absolutely despised rigid corporate rules. In fact, after struggling for years with traditional jobs, he found himself entirely out of money with a pregnant wife. Yet he famously sat outside a government unemployment office for an hour and a half, just refusing to go inside out of pure pride. Driven by this intense fear of failure, he finally took a job launching a credit card program for a licensee bank up in Seattle, even though he personally hated the whole idea of consumer debt. But when Hawk took over the program, he immediately spotted the structural flaws that were causing all this rampant fraud. He proposed a committee of all the member banks to fix the problem, and they ended up making him chairman. Now, traditional banking under men like Beese and Williams was strictly top-down. It was centralized corporate control. Hawk, on the other hand, proposed something radical, a self-organizing, decentralized network inspired entirely by nature. Hawk famously said, "There was no principal blackbird in a flock. There was no president tree in the forest." He realized that out in nature, competition and cooperation just coexist perfectly without any central governing figure pulling the strings. Applying this to finance, he envisioned a distributed network where every participating bank followed a strict set of algorithms and principles, allowing the whole system to function optimally on its own. This brilliant philosophy is what led him to create a totally independent payment network called National BankAmericard Inc., or NBI for short. Let's move right into Section 4, the duality and legal wars. So Hawk gets Bank of America on board, and he steps up as president of this new organization. But now, what's really interesting about this is that secretly, right behind his back, Bank of America had completely betrayed him. They were quietly collaborating with American Express to build a competing nationwide authorization system that would be entirely controlled by them, a move that would have rendered Hawk's whole decentralized dream completely obsolete. Feeling totally blindsided, Hawk and the NBI board made a bold, aggressive move. They broke away from the industry-wide effort and built their own proprietary system called Base 1. That stands for Bank Authorization System Experimental. It was an absolute technological marvel for the time. It could instantly check a cardholder's funds electronically, completely revolutionizing transaction processing, and, crucially, keeping NBI alive and thriving. But the threats definitely didn't end there. During the 1970s, a new giant emerged, Mastercard, which of course we know today as Mastercard. Desperate to protect his creation from this massive threat, Hawk implemented what he called an anti-duality policy. This basically banned any member bank from issuing a competitor's card. Well, this backfired spectacularly. Worth and Bank of Arkansas sued NBI for antitrust violations. And as this legal battle dragged out, the emotional toll on Hawk was just devastating. He received horrific personal threats, someone even slashed his office chair, and he fell into a really deep depression. The contrast between his peaceful, nature-inspired philosophy and this brutal, cutthroat corporate warfare is just staggering. Ultimately, the courts ruled against NBI, which forced Hawk to lift the ban entirely. Which brings us to Section 5, the ultimate financial monopoly. So, despite losing that major lawsuit, NBI was perfectly positioned to ride the wave of an explosion in international trade happening in the late 1970s. But to really capitalize on this, Hawk realized the name BankAmericard just wasn't going to work overseas. It was way too regional. He needed a universally acceptable, highly powerful brand name, so he changed it to Visa. Believing he had successfully built a thriving, decentralized organization that could actually survive without him, Hawk retired, feeling his mission was fully complete. But Visa? Visa evolved into an absolute monster. By the early 1980s, driven by completely new innovations like traveler's checks and those little security holograms on the cards, Visa commanded a massive 60% market share, pushing their billings to a staggering $59 billion. They weren't just a simple network anymore, they were rapidly becoming an undeniable financial titan. So, the absolutely crucial point here is understanding exactly how Visa achieved this level of dominance. And the answer is network effects. It's this inescapable cycle that, let's be honest, you and I are probably part of right now. Think about it. The more merchants accept Visa, the more consumers want to carry Visa cards. And the more consumers have those cards in their wallets, the more merchants are literally forced to accept them. Retailers and consumers alike essentially became trapped in a self-reinforcing system that naturally consolidated into a monopoly-like powerhouse. However, having that kind of massive market power attracted some incredibly intense legal scrutiny throughout the 1990s and 2000s. Major players like Discover and American Express sued Visa, alleging they were colluding with Mastercard to ban member banks from offering any competing cards. And then, shortly after that, a huge coalition of retailers led by Walmart filed class action lawsuits over excessive debit card fees being forced on merchants. These lawsuits resulted in massive, multi-billion-dollar settlements that brought Visa dangerously close to simply running out of cash entirely. Facing these catastrophic legal bills, Visa basically had only one way out. In 2008, right in the teeth of the looming global financial crisis, Visa launched an initial public offering, and it completely shattered U.S. records. They raised a jaw-dropping $17 billion. The incredible irony here is that Wall Street investors were so deeply enamored with Visa's highly scalable money-printing business model that they eagerly poured billions into a company that was literally drowning in litigation. They did it simply because the core operation was just so unbelievably profitable. And you know what? That massive bet paid off spectacularly. Today, Visa's financials are nothing short of breathtaking. In 2023, the company generated $33 billion in revenue, with a net income of $17 billion. It handles over $12.3 trillion in payment volumes. It has fully overcome its chaotic history of those fraudulent mail drops and massive antitrust lawsuits to remain an unstoppable, highly scalable machine that practically dictates modern global commerce. Which leaves us with a really fascinating paradox to end on. Did D-Hawk, this frugal, rebellious nature lover who absolutely despised corporate control, accidentally create the very thing he hated most? He envisioned a decentralized, leaderless network modeled after a peaceful flock of birds. But the unstoppable mechanics of network effects transformed that beautiful vision into an all-powerful, practically uncontrollable financial monopoly. It's a brilliant, somewhat ironic reminder of how the most unpredictable origins can shape the very fabric of our modern world. So, what do you think? Thanks so much for joining me on this explainer, and I'll see you next time.